From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, Fed officials refusing to commit beyond one more hike, rising defaults suggesting that the corporate credit crunch is just beginning, and the banks returning to the Fed's lending facilities in search of more liquidity. We begin with the big issue, the Fed's final words.
A bunch of Fed speak coming out.
That hawkish rhetoric, right now they're in a bind.
The Fed is in a box.
What they're trying to do is go a little too high to prove a point, let the economy soften and come back down.
I think the May 3rd meeting will be their last hike for the cycle.
The message we've been hearing all this week.
Inflation is sticky.
They need to continue on this inflation battle.
The biggest worry for the Fed, what keeps them up at night, is that inflation becomes unanchored.
There is not a zero chance that they keep going.
Being very behind the curve, they've had to chase the rate hikes.
They need credibility.
This is not by any stretch mission accomplished.
It seems like they will stick with that language of data dependent.
I don't see how we can continue to play this short-term data game.
If there's a risk to their actions, it's not that they don't hike enough at this point, it's that they don't cut quickly enough.
Joining us now, I'm pleased to say we have JPMorgan's Lisa Coleman, Invesco's Rob Waldner, and Cliff Corso of Advisors Asset Management. And Cliff, I want to start with you because we got the last gasps of Fed speak, before that May meeting. Has anything changed in your view?
Yeah, I certainly think the regional banking crisis has put a whole new dynamic in terms of how the Fed has to think about where they're heading on their path. You know, they're already obviously jack rates up to this 5% rate. Maybe they go to 5.25%. But they begin to wrestle now with, they broke something. Systemic risks are out there now and lurking. And how do they weigh that now? Have they done enough? And is it time to hike and hold, which is what their forecast is? And as some of your guests were just pointing out, can they really hold if indeed we do hit a recession? So I think a lot has changed. And the other thing that's changed from last year is the Fed is right now, for the first time in a decade plus, in real yield territory. Ex 2019, that didn't work out too well. And so they've done a lot of their job, and hiking and holding, maybe channeling Gretzky, where the puck's going to skate in terms of inflation, is going to be the key determinant, along with a potential recession, in terms of how they play it from here. But we think they hike and hold in May and go away.
Well, Lisa, I mean, it's been one of the favorite thought exercises on Wall Street over the past month and a half, trying to quantify how much what we are seeing in the banking system right now is worth in terms of Fed tightening. When you think about the month and a half that we've just seen, what do you think it means for the Fed on their trajectory of tightening interest rates?
You know, Katie, the Fed has hiked, nearly 500 basis points here. And on top of that, we have QT going on. And what's that, about 95 billion or so, a month. The Fed has certainly hiked a lot. And, as a credit person, I'm looking at things through the credit lens. I mean, we've had, in the month of March, 2 bank failures in the U.S. We've had a number of surveys that have pointed out that credit conditions are tightening, whether it's the Senior Loan Officers Survey, whether it's the Small Business Credit Conditions Survey. We've seen, actually, now that we've had bank earnings coming out, we've seen that loan growth has been relatively muted, whether we're looking at large banks, whether looking at the regional banks. Katie, I think the Fed has done enough, and it's time to stop and to let things fall where they may. We know that the lags between Fed hikes, the entire period can be very long. And just now we're seeing evidence that the Fed has done enough.
Well, Lisa, I mean, to that point that you think that the Fed has done enough, I'm curious what you think is the bigger risk here, that in an attempt to continue to get inflation down, that the Fed tightens too much? And how do you weigh that against the risks that we still have pretty hot inflation over here in the U.S.?
Yeah, I mean, look, you're right about inflation. Whether it's PCE, whether it's CPI, it's come down, but it still is elevated. We actually think that as the economy slows, we will continue to see inflation moving lower. And we've had a little bit of evidence of that. Some of the inflation numbers, when we're looking at that all-important shelter component, when we're looking at primary rents, there is some evidence that that is beginning to wane a bit. And I would also point to things like average hourly earnings. And we're looking at the 3-month annualized rate, the 6-month annualized rate. Those seem to be coming down. And so I think the Fed would be wise to exercise a little patience to allow these numbers to begin to diminish. And I think it's hard, as I said earlier, to ignore the impact that the Fed's actions have had on credit conditions. You know, I talked a little bit about banks, but also, you know, some of the surveys, in fact, the New York Fed's own survey is indicating that consumers are starting to feel that credit conditions are tightening around them. So I think we just need to take a pause here and let's see where we get to over the next several months.
Well, Rob, come in here on this question. What would a policy mistake from the Fed look like right now, especially in light of what we learned from the banks this week?
I think it looks like what you're seeing. I think I agree with Lisa. If we go back to very basic principles here, the inflation is coming down in the U.S. It looks like the peak was more than 6 months ago. Growth is slow. We're not in recession, but it's slow and it's below potential. So it's not a bad macro backdrop, but the Fed is kind of a victim of its own narrative that it's created, that, you know, it's all about core or, super core services, inflation, and that they need to see the unemployment rate go up. So they're looking at an environment that looks very favorable to me from a macro perspective, but they've created a narrative that says they have to continue to hike rates. And I think that's when a central bank makes mistakes, when they don't look at the facts on the ground and instead they act on a narrative. The same mistake they made on the way in, by the way, because the narrative was inflation will never go up. You can never create inflation. And they stuck with that narrative way too long, way past the time that the data pointed the other direction. I think they're doing the same thing now.
So, Rob, I mean, how do you position a portfolio around this narrative that the Fed has created, and for better or worse, they're sticking to it? Where does that leave you when it comes to the Treasury market?
I think that leaves you've got the perfect panel right here, which is your fixed income real yield panel. We finally have real yields to offer. We have a great value proposition for clients. I think high quality fixed income makes a ton of sense because you're getting, over 5% yields in high quality fixed income. You have the protection of what we think is protection of duration. So if the bad outcomes that I can think of now, debt ceiling debacle, recession, some other geopolitical event, all of those, in our view, would come with a lowering of the overall level of interest rates. So by buying a longer duration high quality credit asset, you're getting the nice yield, and you're also building in a little bit of, if you like, potential to benefit or a little protection into your portfolio.
And of course, as we talk about what's going on in the U.S. economy, we should point out that we got some pretty hot data from the UK this week when it comes to inflation. UK inflation rose back into the double digits last month. We heard earlier from Pictet's Ella Haja highlighting the divergence of central banks. Let's take a listen.
There's a big puzzle when it comes to central banks. The Fed's been taking this far more seriously, at least once they realized that this was getting away from them, right? So we've not seen the same commitment from the Bank of England. If they put a firm message on it that they're going to get much more serious and more hawkish, perhaps they're turning a corner, but I would not stake my money on it. For us, gilts are short versus treasuries. And on top of it all, I think when it comes to curves, we would say more of a steepener bias.
So, Cliff, talk to us about what you're seeing when it comes to the trajectory of these different central banks and where that leaves you on the European debt market versus the U.S. debt market.
Yeah, no, I think that's a key point because last year, most of the major central banks were acting in concert. Everyone was behind the curve, and inflation is a global problem, not just a U.S. problem, for secular reasons, which is why we think it'll be sticky beyond the Fed's goal. But if you look at Europe, we have to actually not treat that as one location. You point out the UK has a real inflation problem, 10% plus inflation. So that has implications for more hawkishness in their central bank policy. Conversely, if you look at Germany, the real economic engine of Europe, they had a very soft PPI number. So there's different speeds. It's a multi-speed world now, and we need to pay attention to that. We think there is value over in Europe. It looks like, they're in sync with the U.S. in terms of slowing down and ending, reaching a terminal rate in their central bank rates. But again, some of the locations like the UK they're still in a tightening mode. And you can look at China. You really want to widen it out globally. They're easing. They're trying to kickstart, rev up their economy. So you have opportunity now in multiple markets, including fixed income markets, to pick and choose. It's not just a binary beta trade looking at all rates going up. Now we're getting divergence, which creates opportunity for fixed income investors.
And Cliff, just quickly, I mean, when you look at the global fixed income market, to your point that there's opportunities to be found in Europe, where, when you look across EM, when you look across Europe, UK, US, do you see the most attractive entry points right now?
Well, it may be a little early, and it depends on what country, but we do think EM is quite interesting. There are many EM countries that would benefit from some of the changes in reordering of the supply chains. So if you think about commodity producing EM countries, those are quite interesting. And if you want to go develop markets, everyone loves to hate the banks right now, but not the large banks. Obviously, Credit Suisse has some issues. Deutsche Bank is in the news. But if you look at how well capitalized the banking system is and the spreads that are offered in those markets, depending on where you want to be in the capital structure, we think there's some really good opportunity within the banking market, not only internationally, but also here domestically in the large cap banks in the U.S.
Well, we're going to be talking about the banks next. Lisa Coleman, Rob Waldner, and Cliff Corso. Everyone is sticking with us. And up next, it's the auction block. The big banks hitting up the primary market after a strong first quarter. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we saw AT1 bond sales reopen. This comes just weeks after Credit Suisse's collapse set off a global fire sale of the debt. Japanese firm SMFG sold about $1 billion worth. Over here in the U.S., post-earnings, banks led the charge to a $29 billion week. We had B of A, Morgan Stanley, Wells Fargo, and Bank of New York all with sales. And in the high yield market, the space is gaining momentum this month with a new offering every single day this week. Volume now exceeding $14 billion for April. And sticking with high yield, PGIM's Michael Collins expecting higher default rates to open up an attractive entry point. Take a listen.
When default rates go up, spreads go wider, right? So we are being tactical in this regard. Credit spreads will probably should push 100 basis points wider from here before you get excited and start buying them. But if you bought, I think, the high yield asset class today and held it, for 5 years through the cycle, you're going to earn that excess yield over treasuries. But it's not cheap, right? And I think it gets cheaper as you go through a weaker part of the credit cycle.
Still with us, we have Lisa Coleman, Rob Waldner, and Cliff Corso. And Lisa, that's been one of the stranger features of this economy, that basically this super hot inflation that we have, the Fed's aggressive campaign to cool it, it hasn't translated into higher default rates. Do you see that dynamic changing anytime soon?
Well, it should, Katie. Look, the amount of credit contraction that is getting pushed through the economy now because of the Fed actions will ultimately have an impact on default rates going forward. Our high yield team is thinking we start to approach 3-4% as a more realistic target for high yield defaults. In my world, in the investment grade space, we would expect to see pressure building there as well. And one of the things in the commentary that you had earlier, we're talking about valuations. One of the things that's not priced into our market is a valuation for a recessionary outcome. And in particular, I look at investment grade, with spreads where they are, they're nowhere near pricing in recession. We think you're pricing in the U.S. only about, 25-26% of recession probability. And honestly, when you look back historically and you compare where spreads get to during recessionary times, we could see considerable spread widening to begin to compensate us for those additional risks. So I think, at least in our market, we should see spreads at least north of 200 basis points before it starts to get interesting.
Before it gets interesting, I mean, there's a lot of daylight between 200 basis points and where we are right now. On my screen, I see 130 when it comes to investment grade. What is going to be the catalyst? What is finally going to break spreads out of this range that we've seen, maybe to levels approaching 200?
Yeah, so one of the issues you have right now is there is a lot of demand for fixed income. Rob talked about that earlier, that when investors look at all-in yields, they're probably going back some number of years closer to the 78th percentile, almost 80th percentile in terms of attractiveness. But on a spread basis, we are nowhere near that level. So what are the catalysts that could happen? I think we have to actually find ourselves in recession. And, we spent a lot of time looking at these periods where you have an inverted rates curve. What happens to credit spreads? Well, they tend to move around in a relatively contained range with a bias toward wider. But really where you start to see the material spread widening is when the economy is in recession. And that's when investors finally get compensated for the risks that they're taking by investing in the corporate market. So, Katie, I think you need to see the data. And one of the things that we believe is that we will see the economy move into recession. We think that the tea leaves, we're reading the tea leaves, they're there. And we think by the second half of the year, you will be in recession. And that's when we're going to see spreads really move.
Well, this is the debate that, of course, is taking place on Wall Street right now. And we're starting to see some sides form. You have Goldman on one end doubling down on its bullish stance, saying that highly rated companies can, quote, adapt to tighter bank lending standards. On the other side, you have JPMorgan with the opposite view, saying that basically turn more neutral here. They expect high-grade spreads to widen amid the uncertainty. Of course, Barclays also sounding the alarm on junk, saying that investors basically are too optimistic in this economic environment. So, Rob, what's your view? Obviously, Goldman a little bit more rosy than the rest of the bunch. Where do you fall in this debate?
Well, I think the conversation we just had about if there's a recession, spreads will go wider is 100% true. So it comes down to what do you think the probability of recession is and how bad that recession is. And if you look across the U.S. economy right now, I just think it's very hard to find imbalances that really point to much of a deep recession. So if you don't have those imbalances, you probably don't get a substantial recession. So you get sort of bumping along sort of zero growth. And in that environment, I don't see that much risk to high-quality credit assets. Might spreads go wider a little bit? Maybe. But you have a nice cushion in terms of overall rates now. So that's why we say high-quality corporate credit assets, kind of make sense. We would be a little more cautious around things that might be more tied to the economy, like high yield, where you could see a pickup in defaults. But I want to come back to where I started, which is if the Fed just pauses and does what we might call maintenance cuts, which follows inflation down to keep real yields stable, that would be a very positive environment for asset markets. And I think explains why spreads are where they are. It also explains why the equity market has done better than, many people think it would have.
Rob, it's a great point that this isn't just a credit story. You also have the equity market merrily rallying, it feels like, amid all that we've seen. But Cliff, I want to bring you into this conversation. And what we've been talking about, really this sort of stability that we've seen in spreads, both on the high yield and the investment grade side. Is that a dynamic that you think can continue here?
It certainly can. I'm just thinking back to 05, 06, when the bubble was building. And I think many in the markets, as we did back then, said, gee, something is not right here. Something's probably going to break. Don't know when. If you looked at IG spreads during that horizon, 1-2 years, and high yield, IG generally just bounced up and down around a sort of a 125, 130 spread, which is roughly where we are today, plus or minus, more to the plus side, 50. And then high yield was kind of cuffed around this, 400 level, plus or minus, 100. We're in that pattern right now. And it's because, you see these divergent views. We have it right here, maybe a little bit on the panel, which way it's going to go. So, the spread markets are kind of in the middle. But I would just take a step back. And our view is that we're going to have a recession, that spreads will widen. But if you look at the market dynamics, there's a massive and maybe historic incongruity in the markets right now. You got an inverted yield curve. 3s, 10s have never been this inverted. Obviously not a bad track record, not perfect. You've got 18.5 PEs on equities. You've got kind of in the middle spreads, a little wider, but so it's a confusing time. So you have to make a choice in many ways. Our view is that, we're of the view that a recession occurs. And so spreads would widen. But we do think, if you think about high yield in particular, companies can't default unless their debt comes due. And what the high yield companies did a great job of doing in the last couple of 3 years is pushing out what is known as the maturity wall. when is the real bulk of maturities coming due in high yield? It's going to start picking up next year, but the real storm is 2025. I'm not saying that spreads will hold into 25. Again, our view is recession sooner than later. But I think that's part of the dynamic here. Is a lot of companies may default, but just the debt's not coming due yet.
All right, 2025, mark your calendars. Lisa Coleman, Rob Waldner, and Cliff Corso, everyone is sticking with us. And still ahead, it's the final spread. The week ahead, the last rounds of eco data rolling in ahead of the Fed's May meeting. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up. First Republic out with some of the most anticipated results on Monday. Then we get new home sales and consumer confidence on Tuesday, followed by wholesale inventories and durable goods come on Wednesday, plus U.S. GDP, another round of jobless claims on Thursday. And finally, we have Eurozone GDP and U.S. PCE. Still with us, though, we have Lisa Coleman, Rob Waldner, and Cliff Corso. And it's time now for the rapid fire round. 3 questions, 3 quick answers. Lisa, I want to start with you. Is the Fed's last rate hike in May?
Yes.
Rob?
Yes.
Cliff?
Yes.
Lisa, does the Fed cut rates in 2023?
Yes.
Rob?
Yes.
Cliff?
No.
All right, some disagreement. Lisa, does high yield or investment grade outperform this year?
Investment grade.
Rob?
IG.
Cliff?
IG.
All right, guys, great discussion. Really appreciate it. My big thanks to Lisa Coleman, Rob Waldner, and Cliff Corso. And from New York, that does it from us. We're going to be back same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.